Well, thank you. This is what I enjoy doing most on an annual basis. We'll go through the meeting of the shareholders and the update. The first page is our general safe harbor statement. We'll get the regulatory issues out of the way first and all the forward-looking statements, et cetera, so we can get that one behind us and get down to the good stuff. For some of you that have not been in the past, we'll do just kind of a quick overview as to who we are and what's going on within the bank. We are a single bank holding company. First internet bank was launched in 1999. We became the first state-chartered, FDIC-insured internet bank in the country. Our customers, traditional customers, is somebody that's kind of an early adopter of technology, self-directed in the financial solutions, services solutions. We have a nationwide customer base. Within 90 days of opening the bank, we had a client in all 50 states. All of them are served from a single location here in Indianapolis and literally across the parking lot from where we're holding the meeting today. It's a proven online retail banking system. The lending platform is using best-of-breed technology backed up by exceptional customer service. The low-cost delivery channel continues to add value to the consumers by allowing us to offer higher deposit rates, lower loans and fees on the other accounts. Unparalleled financial management tools and customer convenience via the website. How do we compare? We're a non-traditional banking model. When you try to compare us to some of the typical community banks or commercial banks, we'll have some more slides coming in a second that'll give you more detail into that one. Our financial performance improved geometrically in 2010, narrowing the gap to our peers, where our numbers are looking more and more like a traditional community bank. Key results in the snapshots for the last 5 years are on the next slide here. Kind of the four metrics that we're compared to in the banking community, and particularly the ones that the outside world and analysts tend to look at, is the return on the average assets. On all these charts, First IB is a green line. Our peer group is the blue line. And the return on average asset in the upper left, we've obviously caught up. Historically, we've been behind. This past year. We kind of came out of the economic recovery issues faster than our peers and jumped above. Followed up in the lower left is the return on average equity. Again, we were narrowing the gap. We got ahead of them in 2000, or evened it up in 2009, got ahead in 2010. Net interest margin is one that's always been tough for us because we're paying higher interest rates to the consumer and charging on the savings products and lower rates on the lending side. Our peers appear to be leveling off, and ours is continuing to climb over time. And one of the factors we'll hit several times through the course of the presentation, as we continue to originate more loans internally instead of purchasing on the secondary market, the interest margin should even get better with time. Lower right hand, that's the percentage of problem assets compared to your capital base. And obviously this one, we want to be lower than the peers on the ratio of problem loans to equity, and we're, again, way ahead of our peers. So not only have we come out from an earnings and an interest margin better and faster than our peers, we're beating them on the Texas ratio, which is basically pinpoints potential loans that could be a problem for the institution. Going through our recent performance, kind of a comparison of 2009 and 2010. Net interest income, as I talked a minute ago, our margin has improved. We're above 3% for the first time in the history of the bank. Increased net interest by almost $800,000 over 2009. Non-interest income continues to climb, about a $500,000 increase. The reality is, in the mortgage lending area, we increased non-interest income by over $1 million, but part of that was eaten up in other than temporary impairment on some investments. So the net effect of it is our overall income went up $500,000. We were able to absorb some internal expenses and still turned in good year-end numbers. Provision for loan losses is somewhat skewed here, and taking a look at the numbers, we really didn't cut the losses by $11 million. The reality is we had a large commercial account that we took a preemptive strike and wrote off at the end of 2009. We were able to work through issues with the borrower, reclassify the loan, put it back into operating performance. So in reality, you should deduct $3 million from the 2009 numbers, add $3 million back into the 2010 numbers, but it's still a dramatic improvement. Dropped the overall loan charge-offs during 2010 by almost 50% over what we had in 2009. Non-interest expense, a little bit up. over 2009. A lot of that was increased business that we set up in employees. We expanded the mortgage area geometrically. We'll come to that in a second. Plus, we also established last year a commercial real estate lending arm and staffed up that was really showing fruits here in 2011 that really didn't come through in 2010. Other operating expenses, we continue to invest in infrastructure. I'll give some more details on that in a little bit. So even though it was still kind of a recovery year, we continue to invest in infrastructure in the future, and more importantly, people, to give us some additional opportunities in 2011. We're off to a good start for the first quarter in financial reports and the results for the first quarter. Net income of a little over $500,000 at 28 cents per share in the first quarter. Progress obviously continues to move forward. The net non-interest income is an increase. We talked a couple minutes ago about the 2010 over 2009. In the first quarter, we're actually ahead of the 2010 numbers. Provision expense improved again, a comparison of taking out that one-time reversal that we did, and we actually look at first quarter losses in 2010 versus first quarter losses in 2011. We're on a better position than we were. And the great bottom line that I love, deposits and loans are growing again, and I'll give you a slide next up here that will show the growth we've had since the first of the year. Balance sheet of 2010 versus 2009, we were relatively stagnant. We finished 2009 at about $500 million in assets. We finished 2010 at $500 million. The reality of that was the consumer accounts continued to grow. We paid back some Federal Home Loan Bank borrowings. We also allowed some brokered deposits that we had in the bank roll off. So even though we stayed semi-stagnant from 2009 to 2010, we still actually increased our consumer base. The growth has been tremendous here in the first quarter. Assets are up almost $30 million. The blue line, the red line is the loans. Our loans outstanding are up $20 million. Security is the green lines, which is up $18 million, and we added almost $1 million to the equity on the bottom line. So a very solid first quarter after coming off a very good 2010.